Zero DTE options. They're the talk of the town. They're everywhere. And I want to spend a few minutes walking through them in detail with you all so that you kind of have a better understanding of how they fit into the broader derivatives and financial picture. What's up, everybody? My name's Eric. I run a YouTube channel called ES Invests, and it's really a place where I share over 16 years and 30,000 hours of trading experience with people because I didn't find my way on my own, and I had a lot of folks help me along my path. This is an effort to pay some of that forward, and every once in a while, I get to partner with super cool entities like Barchart. So I want to start us off with probably the most exhilarating part of any sort of social media video, which is the good old disclaimer. So I am not a financial advisor. I am quite literally just a super average dude that's been doing this for a little while. So you should not take anything I say, or really most people say on social media, as investment advice. It is all just information, entertainment purposes only. And these are my opinions. They're not endorsed by Barchart. So with that super fun part aside, let's get into some zero DTE options. So like I was telling you, I've been trading these for a while, and it's actually been really interesting to see the evolution of options. And there's a handful of things I want to talk to you all about specifically as it pertains to the zero DTE type. The first thing is kind of not just what they are, because we have a natural understanding. I want to give you some of the details. What are the Greeks surrounding these products? How do they behave? Things like that. Then I want to start talking to you about some of the common uses that traders deploy them for, both retail and institution. And then I want to talk about the impact they have on the market, because based on those three things, you can decide whether, is this a decent product for you to integrate into your strategy? Is it not? Even if you don't and you trade options, you should be aware of them, and I'll explain to you why that is also the case. So as you can see on the left-hand side here, this is from Barchart. You can see this is VOO, and this is option expirations. So these are normal monthly expirations. One, that denotes them with the M, but two, you can just see that they're staggered the third Friday of every month. That is a standard expiration. But what we're seeing to an increasing degree is something more like this. So if we look over here, this is the SPY, and you'll see this in a lot of index ETFs, the indices themselves, but notice how there's a ton of weekly expirations, and there's even intra-weekly expirations, meaning we have stuff that expires the 21st, 22nd, 23rd, literally each day of the week. So what's happening here is we are opening up additional expirations, and this has quite a few significant market impacts that a lot of people don't know about, and that's really what I want to talk about. This is not new, but to the degree that we're seeing it is kind of new. We haven't seen this level of options flow into such short-term expiration. So I have two supporting documentation pieces here for you. The left one here, the average daily option volume. This is from the SIBO. They produce a report periodically, and you can get a lot of really cool information from it. And then on the right-hand side here, we have something from Rocky Fishman from Goldman Sachs, but I thought it's a sleek visual of what's going on with options volume. So let's start here on the left-hand side, though. This is just average daily volume. And notice, essentially from 2019, the parabolic rise that we're seeing specifically in individual stocks, but you're also seeing it in ETFs. The indices themselves, sort of not quite as much, but definitely between the stocks and ETFs. So all this is telling you is that there are a lot of people trading options. Okay, cool. Got it. Let's pivot over here, though. The short-dated SPX volume as a percentage of total volume. Now we're honing in more specifically on the popularity of zero DTE strategies in an index ETF like SPX. Notice this parabolic rise. Before, this is looking back in 2011, it was probably 2-3% of overall SPX volume. Now it's literally surpassing 40%, and there's periods already where we've seen it tick above 50% of options volume. That is massive. And it's important for people to understand how these things behave, because the fact that there is such an inflow of volume into these products is kind of a problem in some ways, but it's also good in others. And I want to walk you through that. So let's start with Delta. And I'm assuming most people watching this video have at least a rudimentary understanding of options in the Greeks. I'm not going to go through them all in super far detail, but I want to share with you just some basic graphics that I like to use to help people orient themselves on how different aspects of options behave as different conditions change. And what I mean by that is, for example, if we look at delta, which is essentially the directional disposition of an option, it's how much the premium is going to move for every 1 point move in the underlying. And I want you to notice the white line here is 31 days to expiration, and then this yellow line, gold line, is 325 days to expiration. So notice what's going to happen as we get closer to expiration compared to these two. Notice the steepness in this white line, because what's happening as time passes, delta has to make a decision. It's either going to be 1 if the option is in the money, or it's going to be 0 if it's out of the money. So this gets parabolic in nature as we get closer to expiration. This is important specifically as it pertains to market forces, as in options hedging. Whenever you buy, sell an option, more often than not, there's a market maker on the other side of that trade. They need to hedge their risk, which we're going to talk about more in a minute. But this movement in delta is super important as it pertains to time, and it's amplified by gamma. Gamma is, as you probably already know, the rate of change of delta. And in this case, the gold line is inverse. This is the short DTE. This is a 10 DTE option. And then the white line is a 30 DTE option. Notice how high gamma gets for something that is essentially at the money, specifically as you look at it between a 10 and a 30 delta. What's happening here is, just as time is passing and delta needs to make up its mind if it's going to be 0 or 1, gamma is showing you the severity of that disparity. And then the last thing, theta. A lot of people are pretty familiar with the theta decay curve, but what you have on the x-axis here is days to expiration, 200 days all the way over here on the left, 0 days all the way over here on the right, and then we have extrinsic value on the y-axis. That's our time value. And in this scenario, if you look all the way out, 180 days to 90 days, super boring, not much coming out of there. Then it starts to tick up just a little bit, coming from 90 to 60, then from 60 to 30. And then this is where things really start to accelerate. Once you get within 60 days, you're going to see this acceleration pretty much get parabolic in nature. And it's amplified even more when we're within a week. This is incredibly important because when people are structuring different SPX or 0 DTE options plays, they are exposing themselves to all of these forces. So for example, if you are long in option, you have a lot of gamma. We like that. We want gamma if we're long options holders. But the counter to that, which, as you know, in the options markets, it's always give and take. We have really high gamma, but we also have really high theta, which we don't like. And then option sellers are in the inverse. They enjoy heightened theta decay, but they're exposed to a lot of gamma. All of this means is that there are a lot of moving parts, and market makers, again, who are typically holding a book of a lot of these kinds of trades, they need to actively manage all of this risk, which can be pretty challenging. So let's talk about common uses specifically from a retail trader perspective. This is probably my least favorite. I hate seeing it, but it is what it is. This is a really common thing. You see the lottos, meaning it's just people who are just gambling. It is literally off-track gambling at the house at the computer. They just want to use a little bit ton of money. Most of these cases are going to be really far long out of the money options with very low prospects, but they're clinging on to hope via that long gamma. Then we have event trades because we have things like CPI coming out, and that's been really big in the markets, things of that nature. You can use 0 DTE options to give you direct exposure to that. And then the last thing, really the way that I trade them would be either event trades or variance risk premium strategies. If you're unfamiliar with variance risk premium strategies, all that means is we are trying to take advantage of the known heightened implied volatility compared to realized volatility. Leads to decent profit potential if we can time it successfully. So let's talk about the good and the bad. It's kind of like this little Christmas tree diagram. Good is green, bad is red. And in this case, There is a strategic use. Again, I already highlighted that via event trades, whether or not you need a really short-term hedge, if you want to speculate around one of those events. This is a fair product to choose, again, understanding the trade-offs. Then we have the variance risk premium, which is kind of like a really prevalent function, but it's not always there. So if you like to trade for the variance risk premium, you do need to pay attention because there's times where it's in favor and sometimes when it's out of favor. And then let's talk about some of the bad stuff. I already talked to you about the trade structure. No matter what you pick, whether it's long option or short the option, you're exposing yourself to some pretty significant market risks. Again, whatever fits your broader trading hypothesis, fine. But you have to understand that when we're shortening these timeframes into 0 DTE, you are amplifying just about all of the primary inputs into an options pricing model. The other thing is just the misleading nonsense out there about these. People attempt to tout them as them being safer because you're not in the market as long. Again, I just showed you how amplified all of the pricing inputs are. So that safety feeling is really squished down to just about nothing. Sure, you do have less time in the market, but things are priced that way. It's automatically baked into the product. So it's not exactly as safe as people think it is. And then the last thing, you're going to hear the term Volmageddon. And essentially what does happen in different instances, especially if it's like a triple witching where we have multiple things expiring on the same day, the market makers, all the people who are holding large books of these trades and essentially just providing liquidity, they have a lot of work to do. And it's every single day now. It's amplified. So they're needing to hedge a lot. A lot of daily trading volume in these products is becoming simple hedging protocols. But that's a problem because if we start getting a lot of bids in a certain direction or another, we start moving the markets in different ways when really it's not because it's a market consensus. It's because there's just market makers that have to hedge their risk. So 0 DTE options, I think, are actually a really useful tool once we understand how they fit into the broader picture and how we can integrate them into our strategies. But if you want to find out more, feel free to check me out at ES Invest. I'm sure I'll be able to work with bar chart again in the future. And until next time, be an outlier. I'll see y'all later.